At the end of July, the biggest global ETF in Europe quietly got cheaper. Again. Last October, its fee dropped from 0.22% to 0.19%, and on the 28th of July 2026, it dropped again to 0.14%. That's more than a third off in under a year. Here's the thing. Almost every video explaining this fund is still showing you the old number, so let's do this properly. This is VWCE, what it actually is, what it actually costs, and the one number that matters more than the fee, that almost nobody mentions. Welcome to Wealthy in Europe, where we translate confusing money concepts into the European version, because most of what you'll read online was written for someone in America. Quick note before we start. This is education and entertainment, not advice. I'm going to explain how this product works, not tell you what to buy. Every figure on screen is dated because, as you just saw, these numbers move. Do your own research, and if it matters, speak to someone qualified in your own country. So, VWCE. The full name is the Vanguard FTSE All-World UCITS ETF, accumulating. That's a mouthful, so let's take it apart. FTSE All-World is the index, the list of companies it tracks, and it's a big list. More than 3,700 companies across developed markets and emerging markets, large and mid-sized. One purchase, and you own a slice of almost every public company that matters. Vanguard doesn't buy every single one. It uses something called optimized sampling. It holds enough of them, weighted carefully, to track the index closely, without the cost of trading thousands of tiny positions. Accumulating means the dividends don't land in your account. They get reinvested inside the fund automatically. Hold that thought, because it becomes very important later. It launched in July 2019, and it's now the largest fund of its kind in Europe. Now, if you've spent any time on American Finance YouTube, you've heard of VT, Vanguard Total World Stock. Same idea, the whole planet in one fund. Try to buy it from a European broker, and you'll get an error message. That's not your broker being difficult. It's a European regulation. It requires a specific document, a key information document, written a specific way, before a fund can be sold to retail investors here. American funds simply don't produce one because they were never built for our rules. So the asset isn't blocked. The wrapper is. VWCE is that same idea, in a wrapper that's legal here. And as you'll see in a minute, the European wrapper isn't a downgrade. In one specific way, it's built better. Right? The confusion that costs people the most time. You'll see this fund under two different tickers, VWCE and VWRA, and people spend hours trying to work out which one to buy. They're the same fund, identical, same portfolio, same fee, same ISIN. That's the fund's real identity number, and it's the thing you should actually search for. The difference is only the exchange and the trading currency. VWCE is the euro listing. VWRA is the dollar listing. Same fund underneath. And this matters. The trading currency is not a hedge. Buying the euro listing does not protect you from currency movements. The companies inside still earn in dollars, yen, and pounds, and that's what drives your returns. What it can save you is your broker's currency conversion fee, which is a broker cost, not a fund cost. There's also VWRL. That one is different. Same index, but distributing, the dividends get paid into your account instead of reinvested. Different ISIN. Remember that one too. So let's talk about that fee. 0.14% as of the 28th of July 2026. On 10,000 euros invested, that's about 14 euros a year. Not 14 euros a month, 14 euros a year, taken quietly out of the fund's value. You'll never see a charge on your statement. Under a year ago, it was 0.22. Vanguard's reason is simple. The fund got enormous, and the running costs got spread over more money. Here's the part nobody's updated yet. There's a competing fund, FWRA, tracking the exact same index. Its entire pitch was that it was roughly a third cheaper than Vanguard. At 0.15%, it is now the more expensive of the two. That flipped in July. If you're watching a comparison video made before August, it's telling you something that isn't true anymore. One more thing on cost. The headline fee isn't the whole story. What actually matters is tracking difference, how far the fund drifts from its index in the real world. And on that measure, This fund has historically done better than its headline fee suggested. Now, the number that matters more than any of that. Look at the fund's ISIN again. It starts with IE, Ireland. This fund is domiciled in Ireland, and that is not a piece of trivia. When an American company pays a dividend and that dividend leaves the United States, America takes a withholding tax on the way out. The default rate is 30%. But Ireland has a tax treaty with the United States, and Irish funds are structured so they can actually use it. So a fund domiciled in Ireland pays 15% instead of 30%. A comparable fund domiciled in Luxembourg typically doesn't get that rate. It pays the full 30%. Now think about the scale. The United States is by far the biggest slice of this fund. That 15% gap comes off all of those dividends before a single cent reaches the fund. Before your reinvestment, before your statement, before anything you can see. Compare that to the fee we just spent 2 minutes on, 0.14%. The invisible number is bigger than the visible one. That is why around 78% of all European ETF assets sit in Ireland. Not for the weather. And it's the clearest example of what this channel is about. The European version isn't worse. Here, it's engineered. Which brings us to the question people get wrong most often. Is accumulating better than distributing? And the honest answer is, it depends entirely on where you live. Same fund, 4 countries, 4 completely different outcomes. Germany first, because it's the one that catches people out. If you hold an accumulating fund in Germany, you might assume you pay nothing until you sell. You don't. Germany charges something called the VWRA, an advanced lump sum every single year on a fund that hasn't paid you anything. Here's roughly how it works. Germany takes a base rate set each January. For 2026, it's 3.20%, the highest since the rule was introduced. It multiplies your holdings value at the start of the year by that rate, then by 0.7. That's your base amount. You're taxed on whichever is smaller, that base amount, or the actual gain the fund made that year. If the fund didn't go up, there's nothing to tax. Then 30% of it is exempt, because it's an equity fund. The rest is taxed at just over 26%, and you have an annual allowance of €1,000 or 2,000 for a couple. The part that surprises people, it's taken from your cash in January of the following year. Your broker sweeps it from your account. If there's no cash there, that can mean selling something. Ireland, different again. If you've seen our Irish episode, you know it, deemed disposal. Every 8 years, you're taxed as if you'd sold, at 38%, whether you sold or not. Denmark, different again. Danish investors are taxed annually on gains they haven't cashed out, whether the fund is accumulating or not. The Netherlands has its own system entirely, which is being rewritten as we speak. 4 countries, 1 fund, 4 answers. And in some of those countries, the distributing version, VWRL, is actually the better fit. Which is the whole point. There is no universally correct choice here. There's only the correct choice for your tax code. So if you take one thing away, take these 3 questions. 1. Which listing does your broker actually offer, and in which currency? If you're buying a dollar listing from a euro account, check what your broker charges for the conversion. That cost can quietly dwarf the fund's fee. 2. Accumulating or distributing. What does your country's tax system do with each? Not what a video made for another country says. Yours. 3. When you compare it to something cheaper, is it actually the same index? There are global funds out there with lower fees that track a different index entirely, with a different set of companies. Cheaper isn't the same as equivalent. Those are the questions. I'm not going to answer them for you. The answers change at every border, and that's rather the point. That's VWCE, not a recommendation, just the fund, explained properly, with numbers that are actually current as of August 2026. If this was useful, subscribe. We do this for European investors every week. And remember, everything here is education, not financial advice. Your country's rules are your own. Check them. Thanks for watching.